Thank you very much for having me. This is joint work with Marco Dimuthu from Harvard. So the main takeaway of this paper is this paper is about a case study from the US that shows how the use of alternative data can expand credit access to the individuals who are overlooked by the traditional lenders. And also we show that when these individuals get access to credit, their financial health improves. So these are the two major takeaways of the paper. So let me motivate by presenting this figure, which is based on a survey conducted by this fintech company Upstart. So according to this survey, 80% of the individuals who had access to some sort of credit product, they have never defaulted on any of those credit products. But if you look at the types of credit they had access to, less than half of them had access to bank quality credit. So you can see that there is this big mismatch in the current credit system in the US, and also this is worse in other emerging markets as well. One of the primary reasons for this in the US is that the reliance of credit score by the lenders when they're evaluating the creditworthiness, particularly in the consumer lending markets. There are often this credit score threshold that they use below. If you fall below this, you will be immediately disqualified. We're not saying that credit score is a bad measure of creditworthiness. So if you look at the correlation between the default behavior and the credit score, you can see that there is this strong negative relationship between credit score and the default behavior. However, as has been highlighted earlier, there are problems with the credit score, especially if you look at the credit score distribution in the US. There is a large fraction of the individuals who would fall below what is considered an acceptable credit score. Right? So within this segment, there could be individuals like recent immigrants, recent graduates, or self-employed individuals who are actually credit-worthy, but their credit score does not reflect that their credit-worthiness accurately. And that is if you have a credit score. So there are about 26 million individuals in the US, adults, who don't have a credit score at all. These people tend to be younger, lower income, and minorities. Right? So given this data, so our paper is trying to understand, given the advent of fintech lending and big data, can we use these alternative data sources and more sophisticated underwriting models to identify these individuals that we call the invisible primes, who are invisible to the traditional lenders but are of prime quality, by using these technologies. And also we want to look at are their default behavior, is it sufficiently low to give them a low interest rate? So that's not only at the expensive margin, the access to credit, can we also reduce their interest expense as well? And also we want to sort of understand what kind of data, what kind of alternative data would be most helpful in expanding credit access to these invisible primes. And also there is this question that we talked about in the morning, is this good for these people? It's not necessarily clear that more credit is always good. So sometimes more credit can lead to adverse outcomes for these individuals because of overborrowing and mismanagement. So we want to sort of understand, when these invisible primes get access to credit, what happens to their future financial health. And also there could be some individuals who are adversely affected by these alternative data and artificial intelligence and sophisticated underwriting models. So are there any such individuals as well? So these are kind of broadly the questions that we are trying to answer in this paper. And we do so using anonymized administrative data from this fintech company called Upstart, which is one of the major fintech lenders in the US that's listed on the NASDAQ. So Upstart has two key features that is very useful to us. So first, Upstart's underwriting model, they're known for use of alternative data and artificial intelligence in their underwriting, right? So they have about 1,400 variables that are coming from the credit reports, and there are some alternative variables like your education, type of job that you have, whether it's an hourly paid job or a salaried job, or what type of a device you use to fill out the application, this kind of information. And all of this goes to an AI model, and that model gives a probability of default estimate. So that's one feature that is useful to us. We have an underwriting model that is actually used in the industry. And the other important feature is this model was evaluated by the regulator. So it's very easy to come up with a very sophisticated model that can expand credit access, but we have to play within this regulatory boundaries. So we have a model that has been tested by the regulator, implemented in the industry, right? So we have access to this model so that we can test or try and answer those questions that I described earlier. There are several key features that help us get close to the ideal setting that you would want to answer these questions. First is, we have the credit decisions data for all the applicants that are coming to these platforms, and also the interest rates that they're charged. And in addition, we have almost the full information set this platform is capturing to estimate their probability of default. In addition, so I mentioned earlier that the regulator CFPB evaluated this model. When they were evaluating, they ran a counterfactual experiment. They developed a counterfactual model that resembles what a traditional lender would use. And they compared the outcomes of this platform's model to this counterfactual model. And based on that, they decided to let this company to go ahead with this underwriting model. So we have access to that counterfactual model as well, which is basically using all the variables from your credit report and running a logistic regression. And in addition, we have another benchmark model, which is an actual underwriting model used by a large bank as well. So these are the two counterfactuals that we are using in the paper. And another key feature is that we actually have a panel. We observe these individuals at the time of application, as well as 1 year after. Not only the ones who get funding from this platform, also the ones who were rejected by the platform as well. So we can compare their future financial health depending on whether they received credit or not. All right, so we have about 2.3 million disqualified applicants, and we have more than 700,000 applicants who got loans from this platform. So these loans are unsecured personal loans. The average amount is about 10,000. Average maturity is about 3 to 5 years. All right, so now I'm going to show you the differences in the probability of default estimates from this platform's underwriting model, and also from these traditional benchmarks that I talked about. So these are the two main benchmarks that we are using in the paper. The one used by the CFPB, the regulator, and one from a large bank. And also we are using the credit score as our third benchmark. Because this is widely used in industry to evaluate the credit worthiness. And we are comparing this first model to these three benchmarks. Given this is a short presentation, I'm going to focus only on the third benchmark, but the results go through in all when we use all these three benchmarks. So what you're seeing here is that these are all the applications this platform receives, and we have binned these applications into credit score bins. So these are all the applicants with credit scores between 600 and 620. And that's on the x-axis. On the y-axis, we have the platform's estimate of the probability of default, right? So what you're seeing here is that, so the traditional measure says that these are not creditworthy individuals. But the platform's underwriting model that uses alternative data and artificial intelligence says there are some individuals who have very low probabilities of defaults according to them. So these are the ones that we call invisible primes that the traditional models are not able to identify, but these advanced or sophisticated underwriting models are able to identify. This is ex ante. This is before they originate the loan based on the information that they have at the point of application. If you look at ex post default behavior, right? So this is again the same x-axis and the y-axis. So these are different bins. So between 600 to 620, and probability of default between 0 to 5, and so on, 5 to 10, and so on. This color represents the actual default behavior, right? So when the default rate is low, it's light blue, and the default rate is high, it's dark blue. What you see here is that these are indeed invisible primes. So you can see that even though the traditional measure says they are not creditworthy, they are not defaulting. Their default rates are comparable for someone with a very high credit score in the same bucket of probability of default estimates. So these are indeed invisible primes. So to summarize, so now we have this sophisticated underwriting model that is able to identify these invisible primes. And they're doing a very good job at doing that, right? So now the question is, so Also, so this is also like we see that when you look at the performance, you see that the predictive power is very high in this platforms model. Now the question is like, what is driving the superior performance of this platforms model? So we know that they're using this artificial intelligence underwriting model, and also they're using this alternative data. So what is driving? Is it the data or is it the model, right? So we start by trying to understand what kind of data what kind of variables are most important in identifying these invisible primes. What we do is we run this machine learning algorithms to identify which variables are most important predictors of the platform's estimate of probability of default. So we find that after like 15 variables, the effect is not that large. So in this top 15 variables, we have variables like education, the level of education, the type of job that they have, the kind of device that they use to fill out the application, whether it's a smartphone, whether it's a computer, what kind of a browser they use to fill out the application. All of these alternative variables in this top 15 variables. So based on this, like we see that data is playing a huge role, but still doesn't tell us like whether it's which is more important, whether it's data or the more sophisticated model. So let me skip this. And so to sort of disentangle this impact or identify whether this improvement is coming from data or model, what we do is we get this counterfactual model developed by the CFPB, so which is based on traditional variables, and we add these alternative variables to this counterfactual model. And then, so this is a very simple model with traditional variables plus these alternative variables, right? When we do that, what we see is that we can obtain similar performance to the platform's model performance. So this is the sample of borrowers or the borrowers with low credit scores, and that is the sample of borrowers with high credit scores. So you can see that by simply adding these very simple, easy to collect, easy to verify alternative data to this traditional variable set, we can achieve almost the same performance as this very sophisticated model developed by the platform. So based on this, we are arguing that alternative data is actually very effective in expanding credit access to these invisible primes, more so than the very sophisticated artificial intelligence underwriting model. Right, so now, so we know that this model is doing a good job, and that most of this improvements or the superior performance is due to the very simple to collect alternative data this platform is using. Now we are looking at the impacts of this underwriting model on the borrowers. So the first exercise is like looking at the extensive margin. So here what we're going to do is we are going to get all the applicants that the platform, all the applications that the platform receives, and we're going to run this traditional models and identify the individuals who would be rejected by these traditional models. And then we are going to, within this sample, we're going to apply the platform's underwriting model and see who gets approved, right? So these are the ones who are rejected by traditional models, and we are looking at the fraction of the individuals in each credit score bin who are approved among this rejected sample. So you can see in the low credit score sample, or the left-hand side of the credit score distribution, about 15 to 30% of the individuals who would have been rejected by traditional lenders are actually able to get credit because of this sophisticated underwriting model from the platform. And this is same evidence using controls and a regression framework. And now we are looking at the intensive margin. So here what we are doing is for each loan originated by the platform, we calculate the interest rate that they would have received had they gone to a traditional lender. And then assuming that all of these borrowers obtained a $10,000 loan for a 5-year period, we calculate the interest saving that they get by going to the platform. So this is an individual with 620 credit score who's borrowing $10,000 who's for 5 years. And what we see that they're able to save about $8,000 because of the more sophisticated underwriting model used by the platform. So we see effects both in the extensive margin as well as in the intensive margin, right? And then there is the question of like, is this actually better for the borrower? So ex ante, it's not obvious, right? So as I mentioned earlier, it could lead to debt overhang, mismanagement, and adverse outcomes for these invisible primes, or it could lead to better outcomes because now they're able to pay down their more expensive credit card debt and smooth their consumption. That could lead to better financial health, right? So to address this question, what we do is we exploit some of the discontinuities this platform has in their underwriting decisions. For example, if you fall just below 50% debt to income cutoff, you can get a loan from the platform. If you fall just above the cutoff, you are immediately disqualified. So what we're doing is we're looking at the people here and comparing their future financial outcomes. So the future financial outcomes are whether they are defaulting on their credit cards in the future, and what happens to their credit scores in the future, and also whether they are able to obtain a mortgage for the first time. So we see positive effects for all three variables in the low credit score sample, right? And we do not see an effect in the high credit score sample, because if you have a high credit score, you have other options. You can go to other lenders. You have other options. But here we see for invisible primes, because there is not a lot of competition, not a lot of lenders are not lending in this space. So the ones that get access to credit are actually able to improve their financial health compared to the ones who are not able to get credit. So in conclusion, what we find here is that this is just a case study, right? So we are not saying that this is externally valid to all the countries, all the setups. So this is just an example of how alternative data can improve credit access. And so more importantly, what we see is that when we give credit access to these invisible primes, it actually helps improve their financial health in the future. Thank you very much.